Pubs are calling for more flexibility to licensing laws after many Brits had to wait until the second half of the Women's World Cup final on Sunday to be served any alcohol. Subsequently, many fans have been less than happy about the result, while seemingly too sober. Seriously, we need a pint when we want a pint. My name is Jack Reeves and welcome to this week's episode of Tax Tidbits. Following the events on Sunday, the British Beer and Pub Association has said that the current licensing laws were too prescriptive regarding one-off events of national interest. The government has said that these are under review and that temporary tweaks to laws that apply to special events have been approved by the House of Commons and the House of Lords. However, as Parliament is currently in recess, it would have had to be recalled to put these changes in place ahead of the World Cup final, which they were not prepared to do. Instead, the government urged councils to speed up applications for temporary notices, which would allow individual pubs to vary their hours, though this was unfortunately too little too late for many pubs. Despite this delay to sales, pubs across the country reported an increase in trading between 14% and 28% on Sunday, indicating that many people still enjoyed a pint or a few on behalf of the Lionesses this weekend. The Insolvencies service revealed last week that corporate insolvencies fell by 20% in July compared to June and 6% compared to July 2022. Seeing 1,727 businesses in England and Wales close their doors last month. However, the proportion of compulsory liquidations closed by the courts and company voluntary arrangements have both significantly increased. This indicates that larger companies are now having to deal with the current economic and financial challenges, and that many of the smaller insolvencies have been flushed out of the system. Alternatively, individual bankruptcies were 14% higher than in July 2022, but less than half of the pre-pandemic levels. This is likely to be partly due to the government measures put in place during the pandemic, which have had a lasting impact on the financial stability of individuals, but are currently being tested by the cost of living crisis. HMRC have issued letters throughout this month prompting tax agents to correct 2022 tax returns, which include provisional figures, and instead replace them with actual figures. This is in an attempt to maintain compliance standards for agents and reduce their workload in January. However, these letters have not disclosed the names of clients being reviewed, though HMRC has said they will provide these on request. Good job, HMRC. This has led to agents either having to scramble to search through all their clients who may have included provisional or estimated figures in last year's tax return, or spend time contacting HMRC, which is much easier said than done. We have not received one of these letters, so our own clients are not currently affected. It's all about HMRC this week, but HMRC is discussing redrafting MTD ITSA regulations with stakeholders, as currently businesses may be stuck in the scheme until their turnover diminishes to almost nothing. It was announced in December 2022 that the MTD ITSA threshold would commence at 50k from April 2026 and would reduce to 30k from April 2027. Once a business is part of the scheme, the only way for them to leave is for their income to drop below £10,000 for 3 complete tax years. During this period of decline, the company must continue to submit MTD ITSA reports unless they had been in the scheme for less than 3 previous tax years. Subsequently, businesses would be trapped, and the high admin costs associated with these returns could further hinder their cash flow. Halifax, the UK's biggest mortgage lender, has said that housing is more affordable now than it was a year ago due to falling house prices and rising earnings. This year, a typical home in the UK costs 6.7 times the average annual earnings, which is down from 7.3 times a year ago. However, homes are still typically less affordable than they were pre-pandemic, as mortgage costs are now accounting for around 35% of a homeowner's income. This does indicate that the market is slowing down from its rapid growth, but it is still hard to say what the future holds for homeowners. And there you have it. That brings us to the end of this week's episode of Tax Tidbits. We hope you have enjoyed our bite-sized news updates, and make sure to like this video and subscribe to our channel if you found this interesting. We will be right here next Thursday for our next episode, so make sure you do not miss it.